Imagine buying a single share of a company for just a few dollars, then watching that investment grow so much that one share becomes worth hundreds of thousands of dollars. Now imagine doing that over and over again for more than 70 years. No secret formulas, no day trading, no predicting the next hot stock, just patience. That simple approach helped one man build one of the greatest fortunes in history. His name is Warren Buffett. But here's the strange part. Almost everything Buffett teaches about investing sounds too simple. Buy great businesses. Don't panic. Think long-term. If it's really that easy, why don't millions of people become billionaires? The answer isn't what most people think. When people hear the word investing, they often imagine giant computer screens filled with flashing numbers. They picture Wall Street traders shouting across crowded trading floors, or people making millions overnight by picking the perfect stock. But Warren Buffett built his fortune by doing almost the opposite. He spent most of his time reading. Every day, Buffett reportedly reads hundreds of pages of newspapers, annual reports, books, and company financial statements. While others searched for shortcuts, he searched for understanding. And that difference changed everything. But to understand why Buffett invested this way, we need to go back to the beginning. Warren Buffett was born in Omaha, Nebraska, in 1930. Even as a child, he was fascinated by money. At 6 years old, he bought packs of Coca-Cola and sold each bottle individually for a small profit. By age 11, he bought his first stock. It didn't go the way he expected. The stock dropped after he purchased it. Scared of losing money, he sold as soon as the price recovered for a tiny profit. Soon after, the stock climbed several times higher. That painful mistake stayed with him for life. He realized that impatience could be more expensive than making the wrong investment. That lesson would later become one of his greatest strengths. But Buffett still needed someone to show him how successful investing really worked. That person was Benjamin Graham. Often called the father of value investing, Graham believed that the stock market behaves like an emotional person. Some days, that person offers to sell you part of a business at a very cheap price. Other days, the exact same business suddenly becomes expensive for no good reason. Graham called this imaginary person Mr. Market. His message was simple. Don't let emotions control your decisions. Instead, focus on what a business is actually worth. Buffett studied under Graham at Columbia Business School and later worked for him. Those lessons became the foundation of Buffett's entire investing career. But Buffett eventually realized something important. Buying cheap companies wasn't enough. Here's where the story takes an unexpected turn. In the 1970s, Buffett met Charlie Munger. Munger challenged one of Buffett's biggest beliefs. Instead of buying average companies at bargain prices, Munger argued it was better to buy outstanding companies, even if they weren't incredibly cheap. That idea transformed Buffett's strategy. Rather than chasing the lowest prices, he began looking for businesses with something special. Strong brands, loyal customers, reliable profits, companies that competitors couldn't easily replace. One famous example was Coca-Cola. In 1988, after the stock market crashed the previous year, Buffett invested billions into the company. Many people already knew Coca-Cola, but Buffett saw something deeper. People around the world drank Coke every day. The brand had existed for generations, and customers kept coming back. Decades later, Coca-Cola has paid Berkshire Hathaway billions of dollars in dividends while the shares themselves have grown dramatically in value. Buffett wasn't buying a stock. He was buying part of a business. That mindset changed everything. Another example came years later with Apple. For decades, Buffett avoided most technology companies. He often said he preferred businesses he could easily understand. Many people assumed he would never invest in a company like Apple. Then, in 2016, Berkshire Hathaway started buying Apple shares. At first, people were surprised. But Buffett explained his reasoning. He didn't see Apple as just a technology company. He saw one of the world's strongest consumer brands. Millions of customers upgraded their iPhones again and again. That customer loyalty created enormous value. Over time, Apple became Berkshire Hathaway's largest investment and generated tens of billions of dollars in gains. Almost nobody expected Buffett to make such a move. But he wasn't changing his principles. He was applying them in a new situation. So what exactly made Buffett so successful? Many people think the answer is picking perfect stocks. The real answer is much less exciting and much more powerful. Compounding. Imagine planting a tree. The first few years it barely grows. Then every year it gets bigger. Soon it produces more branches, more leaves, more seeds. Money works the same way. If you invest $10,000 and earn 10% in 1 year, you have $11,000. The next year, you don't earn interest on just the original $10,000. You earn it on $11,000. Then on even more the year after. Over decades, this growth begins to accelerate. Albert Einstein is often quoted as calling compound interest the eighth wonder of the world, although historians debate whether he actually said it. Whether he did or not, the idea remains true. Time can become an investor's greatest advantage. Buffett himself has often pointed out that most of his wealth came after the age of 50. Not because he suddenly became smarter, because compounding had decades to work. But that's only part of the story. Buffett's greatest advantage wasn't intelligence alone. It was emotional control. During financial crises, many investors panic. In 2008, as the global financial crisis shook markets, stock prices collapsed. Fear spread everywhere. Many people sold their investments to avoid even bigger losses. Buffett took a different approach. He famously wrote, "Be fearful when others are greedy, and greedy when others are fearful." Instead of running away, he invested billions in companies like Goldman Sachs during the crisis. He believed that great businesses would eventually recover. History proved him right. This doesn't mean every falling stock is a good investment. It means successful investors separate temporary fear from permanent problems. That's much harder than it sounds. Because when everyone around you is panicking, staying calm feels almost impossible. Buffett also follows another rule that sounds simple but is incredibly difficult. Only invest in businesses you understand. Imagine someone offers you the chance to buy half of a local bakery. You know the customers. You understand how it makes money. You can judge whether the owner runs it well. Now imagine someone offers you half of a business using technology you can't explain. Which investment would feel safer? Buffett believed understanding reduces unnecessary risk. He often said that risk comes from not knowing what you're doing. That idea helped him avoid many investments that looked exciting but carried hidden dangers. It also reminds us that saying no can be just as important as saying yes. By the time Warren Buffett became one of the richest people in the world, many expected to discover some hidden investing secret. Instead, they found something surprisingly ordinary. Buy excellent businesses. Understand what you own. Ignore the crowd. Stay patient. And let time do most of the work. These ideas won't make someone rich overnight. In fact, they almost guarantee the opposite. They require years of discipline while others chase quick profits. But Buffett's story proves that extraordinary results don't always come from extraordinary complexity. Sometimes they come from doing simple things consistently, while almost everyone else searches for shortcuts. In the end, Warren Buffett didn't turn simple investing into billions because he knew something nobody else did. He turned simple investing into billions because he had the patience to keep following timeless principles long after everyone else gave up.